In this video, I'm going to show you what the new week opening gap is, why it's so important, and why you need to implement it into your trading strategy, and I'll show you exactly how to do that. So, the new week opening gap, also known as the NWOG. This is the gap between Friday's close, as you can see here. This is the 15-minute chart. Here's a 15-minute candle on Friday, the last candle that closed there, and then the gap between that candle and Sunday's opening. So you'll find that every week there will be some form of gap here between Friday and Sunday. Now this area is important because it's a very strong draw on price, and price will often make its way back to this level and it will react very strongly to it. So you want to have this marked out every single week and keep it on your chart for the entire trading week, okay? So you're going to expand it out and I'll show you how to do that in just a second. Now the reason why you're going to be using this is it's used to form extra context, confluence, and narrative in your trading, and I'll show you how to do that on the charts. Just a note as well, you're going to want to draw this out on using the 15-minute chart every week. It looks a bit different on different time frames, but ICT suggests using the 15-minute chart, so we're going to use that. So here we are on the chart now. This is Friday 6th of January and Sunday the 8th of January, okay? So there's a little gap formed right there. Now what you're going to do, I had this pre-marked out, but I'll just pull it across here. You're going to mark out this area as your new week opening gap. Now remember how I said that price is often drawn to this level and it will often find a way to make its way back there? Well, look at this. Price gapped up, moved up. What did it do? It came down and touched the gap. Kind of like a fair value gap, I suppose. So it's come down, touched it, and immediately reacted strongly. It's shot right up there, okay? So you're going to want to mark it out. When you do mark out the new week opening gap, you want to have it expanded from Sunday all the way through to Friday. Sunday to Friday for the whole week, okay? Now just to further illustrate my point about this level being important, so see how it's come up here, touched once, it's gone up, come back down, and now it reacted again, but the sell side was so strong it's pushed through. But look here, look again. Price has come up, retested that gap. It's retested the gap right there and continued on downwards. And again, over here, touched the gap, come downwards. And remember, this is a 15-minute chart, so if you're scalping, like most ICT students will be, if you're scalping, if you're dropping down onto the 5-minute, the 3-minute, the 1-minute chart, every time it touches this gap, that's a sizable move. Say if you were to short it there and wrote it down, look, that's well over 5 handles, okay? And it does it again here, touches the top, drops down, and then there was some news here, and obviously news doesn't really respect these levels as often, so it's gone a bit crazy and continued on upwards and left it for the week. Now, that's that week marked out. I've gone ahead and marked out the other new week opening gaps just so I can show you how price reacts to these levels. Look at this one from February. We had the gap here. Price comes up, touches, flies upwards, comes down, doesn't quite touch it, touches again, see, everywhere the new week opening gap is, price has a reaction to it. Look at that. That looks like a true form of support and resistance somewhat, doesn't it? So how would you use this in trading? Well, say for example, over here, we have a fair value gap in here. Not only is there a fair value gap, there's also the new week opening gap here. That's an extra confluence. Fair value gap plus new week opening gap. You can say quite confidently that price will go upwards from here with this fair value gap and the new week opening gap. It's going to react from there. So you can use it as extra confluence. And again here, when it comes down and touches the new week opening gap and the fair value gap and rebalances it, you can be quite confident that price is going to go up again. And look, it shot right up. And not only can you use it as confluence for trade setups, also say for example here, say you're watching this fair value gap over here. So keep in mind this box above here, let's mark it out. This box above here is the new week opening gap. Okay, that's your new week opening gap. Say for example, you saw this fair value gap and you thought that price might come back up, touch the fair value gap and continue downwards. Well, in this case, no, you'll find that when price is close to a new week opening gap, it's going to be drawn there. What did I say before? It's a strong draw of liquidity, a strong magnet, I suppose, for price. So if prices come all the way up here to this fair value gap, and it's so close to the new week opening gap, the higher likelihood is that your short in this fair value gap is not going to work. And in fact, you're going to want to start looking for longs reaching up into the new week opening gap. So you'd scratch the idea for that fair value gap, and you'd maybe look at, for example, something in here. Okay, you might look for the gap in here to enter onto and follow up into the gap and set that as your take profit target instead. Okay, so you can use it as narrative, a way to kind of frame the market. If price is near the new week opening gap, it's more likely that it's going to draw towards that level. So look for setups that would be a good entry to ride you up into this gap. So that's the new week opening gap in a nutshell and simplified. Use it in your trades. You need to have it marked out every single week. It's essential to add into your toolbox to use in order to give you extra narrative and extra confluence in your trade setups. Thanks for watching, and check the playlist linked for more ICT Concepts Simplified.